Alright, so in this video we're going to talk about why Warren Buffett's 90-10% asset allocation will not work for you in retirement, or probably not. Basically, the 90-10 split is Warren Buffett putting 90% in an IVV or a VOO, a very low fee stock index fund, and 10% in short-term government bonds. Now, I believe the reason behind the short-term government bonds would be they're going to be the least volatile bond, and essentially in a market downturn, that's where you should be withdrawing your money, is out of short-term government bonds. Alright, so basically the easiest way to explain why Warren Buffett's strategy will not work for the average investor is he is a billionaire and you are not. If Warren Buffett lost half his money, which we've seen in the S&P 500 before in 1 year, he's still rich. He still has a lot of money. He's never going to outlive his money. But the number one concern I'd say for retired investors would be, is my money going to last? So that's what we're going to take a look at today. Now, I did choose IVV in my comparison, so I just want to take a quick look at IVV and VOO. I've had some questions being like, why don't you like VOO? It's not that I don't like VOO whatsoever. It's the same thing as IVV. It's just IVV was here first. I can look back farther. It has the same expense ratio. Basically, I think YouTubers just gravitated to VOO because they like saying VOO. So if you needed to know why, that's why. So let's look at the S&P 500 from Vanguard VOO. Basically, you're looking for a large cap, your US large cap. That's what you're actually looking for, not the S&P 500. That's just, an index that someone created. We're looking to buy large companies. And if we look at the performance here, the 10-year on VOO is 12.82, and the 10-year on IVV is 12.82. When we look at the inception, IVV was incepted back in 2000. VOO, I believe it's up here, was incepted back in 2010. So essentially, I can look back 10 more years, and IVV was here first. Why are we messing around with something that was doing its job in the first place? Again, it's just marketing. Maybe you prefer Vanguard over BlackRock. That's your choice. It's no different than picking your favorite hockey team. Okay, so we're going to go into Portfolio Visualizer and kind of look at what a retirement's going to look like. So let's say you have $1 million the day you retire. We're going to withdraw a fixed amount monthly and adjust this for inflation. We need more money as time goes on. But essentially, when we start our withdrawal amount at $6,000 a month, annually, that's going to be $72,000. So that's going to be a 7.2% withdrawal rate. I mean, that's basically a lot of money. You have to have a portfolio that's getting returns in order to have that high of a withdrawal rate. So in this first comparison, Portfolio 1, we're going to take, Warren Buffett's advice, 90% in the S&P 500 and 10% in a short-term bond. This is shy. And, what I believe, let's say the average retiree might have the day they retire. So a 60-40 split. We're going to look at that as well with a short-term bond. We're also going to look at TLT, so compare a 60-40 portfolio using a long-term treasury. So let's analyze this portfolio and kind of see what it did. So again, the first portfolio is Warren Buffett. The second portfolio is Warren Buffett's, but a 60-40. And this would be the 60-40 again, but using long-term treasury bonds instead of a short-term. When we look at the final balances here, the second one with the short-term bonds, it didn't make it throughout this person's retirement. Maybe I'll scroll a little bit lower. And when you're pulling money out of Warren Buffett's, using Warren Buffett's strategy, you're still going to have 871,000 after, what is that, about 20 years or so? So you can see this person just ran out of money with the short-term 60-40 split. And yeah, you can say, oh, well, Warren Buffett's strategy outperforms yours. Like, are you sure? Why are you telling me it isn't going to work? Well, this person retired in 2000, at the end of 2002. So when we look back here, okay, that's great, it works, but we had a little bit of time to grow our money before that large crash. We never know when a crash is going to come. We just have to prepare our portfolio for it. Now, when we use long-term bonds in a 60-40, a much lower risk tolerance portfolio, that one's in the gold. Basically, you can see, okay, Warren Buffett outperformed it, but using a long-term treasury and a 60-40 split, you were basically beating Warren Buffett's portfolio like the majority of the time through your retirement. The 90-10 split just kind of came ahead right near, I mean, the end of the last year and a half is when the 90-10 split recovered to have more money. Now, essentially, yeah, this all looks good, but let's just add a little bit of gold into the portfolio. So what we're going to do is say, hey, we're going to use, let's say 20% short-term bonds, 10% long-term bonds, and 10% gold in the portfolio too. So let's try to see what happened here. So we can only look back to 2006 in this example. So we have about, what is that, 15 plus years of a retirement that we're looking at. So again, we're still taking out the $6,000 a month. That's $72,000 a year for the very first year of retirement. It's going to increase year by year, along with inflation. So let's look at what happened in this scenario. So when we look at the 90-10 split portfolio, right before that large 08 drop, your 90-10 portfolio actually had the least amount of final balance. I mean, you still have $400,000 left to, hopefully last you another, let's say 5, 10, maybe even 15 years from you retire. But yeah, this is basically why I do not recommend any retiree have a risk tolerance more than 75%. Now, there can be rare instances. Let's say you didn't pull your money out quick enough, you're in the middle of a downturn, basically putting your money in a very short-term, no or low-risk investment, like a 3-6 month GIC. Just know you have to put your money back in. And when you do put your money back in, you're going to have to use a higher risk tolerance to get your money, ahead of time. And another reason why I highly suggest not using a 90-10 split in retirement is this drop right here is going to make 99% of you panic. Basically, when you're at the bottom or the drop, it's just human nature that you're going to sell out and, buy a low-risk investment. Maybe that's a treasury if you're American or a GIC if you're Canadian. And again, I just mentioned a strategy. Make sure it's short-term. If you're going to lock in your GIC for 5 years and only get, now you're probably getting around 5 or 6%. But essentially, the 90-10 portfolio should recover itself by that point. I mean, 5 years is a long time not being in the stock market. 4 out of every 5 years, the stock market will go up. 1 out of every 5 years you will lose money, and basically this is why you diversify your money. I find everyone's looking for dividends, everyone's looking for yield, everyone's looking for low fees. I'm glad you're paying attention to these things, but there is a lot more under the hood that you really need to look at when you're planning your retirement. So when putting in gold, we can only look back to 2006 using BlackRock's product. I used all BlackRock products just in case everyone was wondering. And again, I'm not against Vanguard whatsoever. If you like VU over IVV, that's fine. I just find, again, people like saying VU. I own VU. Great, I own IVV. But really, you need to know that these are just ticker symbols. They do mean something. IVV is the iShares Core S&P 500 ETF. TLT is the iShares 20-plus year Treasury Bond ETF. This is just a ticker. You need to be buying, companies, corporations. This is the ETF name. This is like your fund. But yeah, essentially you can see in the first one here, the 90-10 had a maximum drawdown of 46%. I'm almost guaranteeing you 99% of you would jump out of the market and be extremely hesitant to jump back in with that amount of max drawdown. And essentially all that's going to do is create a really shitty retirement for yourself. So using... even just, let's look at the last one, IVV TLT. This is in your gold. That outperformed. Even using gold. Right? So, you don't have to use gold all the time. But let's make this maybe a little bit more accurate here. So we're going to put 20% in gold and 20% in the long term. Just kind of see how this one did. So again, the one I'm adjusting is portfolio 2. And when you do it this way, put half your money in long term and half your money in gold, we almost still have as much as what we started with. And definitely a reason why I highly recommend gold. Now you should have all these pieces in your puzzle. A short-term bond, a long-term bond, maybe some corporate bonds, maybe some global bonds, maybe some gold, maybe some cash, your T-bills. But essentially, I'd rather have 900, 5,000 at the end of the road, or not the end of the road, maybe, halfway or 2/3 of the way through your retirement. Because, yeah, Warren Buffett's 90-10, you're left off with 418,000. You have half the amount of money using Warren Buffett's strategy. And this is why I highly recommend not being 90-10 in retirement. Adding gold short-term and long-term, that's a very diversified fixed income portion of your portfolio. And you can see why you want to use a strategy like that. So again, I hope everyone's, oh, you're making fun of Warren Buffett, I'm not making fun of him at all. Yes, he is 1 week away from potentially shitting his pants, and you guys are taking advice from this old guy who's a billionaire. He is not in your shoes. You are nowhere near this gentleman's wealth. He is rich. He will be rich until the day he dies. Unfortunately, the average investor won't. You don't have that luck, unfortunately. You didn't start a multi-billion-dollar company. So hopefully you learned something today. That's reasons why we pull back your risk tolerance in retirement, or why you should. Basically, it's going to help with the longevity of your money, and we don't diversify because we want to. We diversify because we have to. It's what's in your best interest. All right, so hopefully you guys learned something in this video today, and take care.